Okay, Chapter 14. Chapter 14 deals with long-term liabilities. The bulk of what we're going to talk about are bonds payable. And I guess first to get the ball rolling, we're going to have to deal with some definitions. Again, Chapter 14 deals primarily with notes payable and bonds payable. Notes and bonds are similar, but they do have some differences. Most of the problems we do in class and in the homework will be bond problems, but the concepts are easily transferable to notes payable. Um, Again, as I said, bonds and notes have a lot of similarities, but there are some differences. Just going bullet point by bullet point, sort of a not very descriptive one, bonds are more formal. They often involve a written what's called an indenture, which describes the bond issuance, the legal terms, and so on. Notes payable can be less formal. A note can be as simply as an IOU. Bonds payable are often, but not always, publicly traded on exchanges. Notes payable, generally not publicly traded on exchanges. Bonds payable, if they're traded on exchanges, then the Securities and Exchange Commission gets involved, the SEC. So it would be SEC oversight, SEC reporting requirements. In the case of notes payable, it's a private contract between two or more individuals. No SEC oversight is involved. Bonds payable tend to be used for larger borrowings. Notes payable tend to be used for smaller borrowings. And tied in with that, bonds payable may, but it's not required, but they may have multiple lenders. Notes payable tend to only have one lender. Bonds are generally issued in $1,000 increments. Each bond is essentially a $1,000 IOU. So if a corporation wants to borrow $1 billion, they would issue 1 million bonds, each representing a $1,000 IOU. And again, this is why they can access larger amounts of capital. Instead of having to borrow money from a single individual, they can borrow money from multiple individuals as part of the same transaction. One creditor may buy 10 bonds, essentially loaning the corporation $10,000. Another creditor may buy 100 bonds, thereby loaning the corporation $100,000. Again, in this manner, the borrower can borrow from a larger group of lenders and raise more capital. Again, promissory notes payable tend to be with a single lender. If ABC wants to borrow $1 million, they sign a contract, again, essentially an IOU, a promissory note, with a bank or an insurance company or a mutual fund or some other lender. When a company issues bonds, they're essentially borrowing money. Interest is generally paid periodically, and at some point in the future, the loan has to be repaid. Now, in England, they used to have what were called perpetuities, and a perpetuity is essentially a bond that lasts forever in perpetuity. Those never really caught on in this country, so bonds have fixed maturity dates. We have a bunch of definitions. First, the bond indenture. This is the legal document describing the bond. It describes how much will be borrowed, how much interest will be paid, when interest will be paid, when the bond will mature, and so on. There's the face or par value of the bonds. This is the face amount of the bonds. It is the amount to be repaid at maturity, and it's the amount upon which periodic interest, if any, is based. At this point, it's awfully tempting to say that this is the amount borrowed, but that's not exactly correct, because we probably won't sell the bonds for exactly face value. The bonds might have a face value of $1 million, and we sell them for $1.2 million, so in effect we're borrowing $1.2 million. The term or duration. Bonds, again, they eventually mature and have to be paid off. This is the legal lifespan of the bond. You borrow money for 10 years, or 20 years, or 30 years, or so on. The dated date. The dated date, I wish there was a better term, but there's not. This is the date on which the bond's legal existence begins. Again, the bond is a legal instrument described in the bond indenture. It has a specific date on which interest starts accruing. The issue date. This is the date on which the bond is actually sold to investors or creditors. The dated date and the issue date are probably not going to be the same for a number of reasons. First, the dated date might be January 1st. New Year's Day, business is not transacted, so you probably won't issue any bonds on January 1st. Secondly, it takes a long time to bring bonds to market, 9 months, year and a half, 2 years. So, let's say that it's now the first week of January, and we say, well, gee, we want to borrow some money for a major project. Let's go ahead and drop a bond indenture to borrow money January 1st, 2014, a year from today. By the time January 1st, 2014 rolls around, we might not be ready yet. So we say, well, we can't issue the bonds yet, but the indenture, the clock starts ticking. Alternatively, we might have a short-term spike in interest rates. We say, look, we don't want to try to borrow money in this environment. We think interest rates will drop in the next 2 or 3 months, so we're just going to hang on to these bonds and try to sell them later when interest rates drop a little bit. So the issue date and the dated date are not going to coincide except in textbook examples generally. The maturity date, the date the bonds mature and need to be paid off. So basically you start with the dated date, January 1st, 2013. You add the term, 10 years, and that takes you to the maturity date, December 31st, 2023. Or 2012, sorry. Interest payment date. Bonds almost always pay periodic interest. Now in some cases, they have what are called zero coupon bonds, which don't pay periodic interest, but that's a special case. Generally, bonds pay periodic interest, either annually or more commonly, semi-annually. So for example, interest may be paid semi-annually each June 30th and December 31st. Now there are two different interest rates we need to be concerned with. The first is the stated or coupon or nominal interest rate. These terms are synonyms. So sometimes I'll say stated, sometimes I'll say coupon, sometimes I'll say nominal. They all mean the same thing. This is the percentage of face value paid as periodic interest. Interest rates are always quoted as annual rates, always, always, always. So if interest is paid semi-annually and it says there's a 4% interest rate, it's your job to say, okay, 4% paid semi-annually is 2% per 6 months. The effective or yield or market interest rate is the rate that the credit market actually demands from that borrower. This will never, except by really weird coincidence, be equal to the stated rate. If you think about it, but again, in the textbook, a lot of times the stated rate is equal to the effective rate just for convenience in writing textbook problems. But if you think about it, the stated or coupon or nominal rate is the number written in the bond indenture, and there's going to be a temptation to choose a nice round number, 5%, 4 3/4, 5 1/8. It'll be a reasonably round number. The effective or yield or market rate is the rate that's determined by the interaction of all the borrowers and all the lenders in the credit markets. And it's affected by inflation expectations, the borrower's creditworthiness, the real rate of interest, all of these various factors. So those two rates are, again, never going to be the same, except by really weird coincidence. Okay, let's go ahead and look at some bonds, see how these definitions can be illustrated. This is the bond screener from finance.yahoo.com, and let's go ahead and look at the first one on the list, the Dayton Hudson Corporation. Now the first column after the bond issuer's name is the price, in this case 131.00. Bond prices are expressed as a percentage of par value. So in this case, the Dayton Hudson bonds are selling at 131% of face value. If it's a $1,000 bond, you'd have to pay $1,310 to buy it. The coupon rate is, again, the stated or nominal rate. That's the percentage of face value paid as periodic interest. In this case, 6.75% or 6 3/4%. So if you were to buy a $1,000 Dayton Hudson Corporation bond, you would get annual interest payments of $67.50. If the interest is paid semi-annually, which I expect that it is, it would be that $67.50 would be split into two equal payments of what, $38.75 each. Next, we've got the maturity date. This is the date on which the bonds mature. In this case, January 1st, 2028, about 15 years away. And there are two yield figures given there. There's the yield to maturity, YTM, and the current yield. The yield to maturity is the rate of return the bond buyer would earn if he or she bought the bond today at 131 and held it until it matured in 15 years. Now in this case, if you notice, the coupon rate is 6.75%, but the yield is only 4.099%, essentially 4.1%. Why is the yield to maturity less than the coupon rate? The reason for that is if you buy the bond, you've got to pay $1,310. When it matures in 15 years, you only get $1,000 back. Basically, you surrender that extra 31%, or you surrender that extra $310 that you paid. So that's going to reduce your return as the bond buyer. The current yield is the periodic interest payment divided by the price of the bond. It's analogous to the dividend yield if you talk about that in your finance class. It's essentially the annual interest payment divided by the price of the bond. In this case, $67.50 of annual interest divided by a $1,310 purchase price would yield 0.05153%, or sorry, 0.05153 or 5.153%. Two other things which aren't really important from an accounting perspective, but they're important to know. First is the bond rating. That reflects the creditworthiness of the borrower. Dayton Hudson Corporation has an A credit rating, so they're deemed to be a good credit risk. That's a high-quality bond. Directly below them, Alcoa, Aluminum Company of America, their bonds are rated BBB, which is a fairly low credit rating, so they're not a very good credit risk. The last column is callable. None of these bonds listed here are callable. A callable bond is one where the bond issuer can essentially what's called call the bond. They have the option of buying the bond back from the bondholder at some predetermined price. So if they wanted to exercise it, they would notify the bondholder that they were calling the bond, and they would buy it back at some prearranged price. Now let's look at Dayton Hudson Corporation in a little bit more detail. Basically, if you click on the link on the previous screen, you get this little pop-up for the bond you clicked on. And the first first six of those we talked about already, from the price through the Fitch rating. Directly below the Fitch rating, it says coupon payment frequency, and that's where it tells us the bonds pay interest semi-annually. Below that, the first coupon date, 1 July 1998. Now, interest is paid in arrears, is paid after the fact. So if interest is paid semi-annually, and the first interest payment is made 1 July 1998, that means that the bonds started their legal existence 6 months before that, 1 January 1998. And if you go down to the lower box, the dated date is listed as 1 January 1998. Okay, let's go ahead and take a look at a couple other bond issues just to illustrate a couple points. Let's look at the first two here, Commercial Metals Company and Computer Sciences Corporation. Note that they both have a coupon of 6.5%, and they both mature 4.5, 5 years from now. Commercial Metals, first, they're selling at a discount. When a bond sells for less than face value, in this case 97.75% of face value, it's said to sell at a discount. And what causes that is essentially the bond doesn't pay enough interest. In this case, the coupon rate is 6.5%. The yield to maturity, again, that's the rate that the bond market is demanding of this borrower, is 6.99%. So the bond doesn't pay enough interest. In order to sell it, they gotta drop the price. So the bond sells at a discount. Note the credit rating here. Commercial Metals has a BBB, which is not a very high credit rating, which means, again, that causes them to have a higher borrowing cost, a higher yield to maturity. And basically what's going to happen is whoever buys these bonds can buy them for 97.75%, or essentially 98 cents on the dollar. When they mature in about 5 years, they're going to get back 100%. So in addition to getting 6.5% as the coupon or stated cash interest, they're also going to get that 2.25% depreciation over 5 years. That's what causes the yield to be more than the coupon rate. In contrast, Computer Sciences Corporation is selling at a premium. The price of those bonds is 106.65% of face value. And again, what that means is these bonds are paying more than the credit market demands. In the case of Computer Sciences Corporation, the yield to maturity is about 5.25%. The bonds pay 6.5%, so everybody in the bond market says, hey, these are great bonds. They pay more than they should. They pay more than Computer Sciences Corporation should have to pay to borrow money, so people bid the price up until the market clears. In this case, again, the bond buyer is going to pay 106.65% of face value. When the bond matures in 5 years, they're only going to get back the face value. They're going to lose that 6.65%. So that's what causes the yield to be less than the coupon rate of interest. Yes, they get 6.5% as annual interest, but they also lose on the excess value of that bond. They lose that extra $66.50 that they paid for the bond. Okay, let's go ahead and do one more slide. First, I want to illustrate some examples of bonds that sell at substantial discounts or substantial premiums. First, the case with substantial discount. Here we have Station Casinos Inc. The bonds have a 6.5% coupon, and you can buy them for 2.3% of their face value. So a $1,000 bond can be bought for $23. Sounds like a great deal. Look at the yield to maturity. If you hold this bond is going to mature at about 1 year. If you hold this bond until maturity, you will earn a whopping 378.9% annually. What could be better? Now, what's the problem with this? Well, the problem with this is you probably won't get paid. The only reason for a bond to sell at such a steep discount with such a high yield is because that's compensation for the risk that you're bearing of not getting paid. At the other extreme, boing, 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 a Federal Home Loan Mortgage Corporation bond, a Fannie Mae bond. In this case, the bond is a 6.75% coupon, and it's selling for 154.46% of face value, a 54% premium. The yield to maturity on that only 3.008%. Now, a Fannie Mae bond, again, the station casinos, the reason they're selling at such a discount, the reason they have such a high yield is because of the risk that you're not going to get paid. The other extreme, the Fannie Mae bonds. Fannie Mae is a government-sponsored entity. Essentially, those bonds, although they're listed as corporate bonds, they're backed by the U.S. government, factually, if not legally. The Federal Reserve has, of course, been essentially monetizing the U.S. debt. They've been pumping all sorts of money into the mortgage market. The current bout of quantitative easing 3, the Fed is buying mortgage-backed securities such as Fannie Mae bonds, which is what's driving down the yield on these bonds.